In this video, I'm going to cover monetary policy. There are three different ways that the money supply can be shifted. The Federal Reserve does this, and they can do this through changing the reserve requirements, through changing something called the discount rate, or through open market operations. The Fed is now chaired by Jerome Powell. If you have a bank account, where is your money? A small percent of your money is held in reserve, and the rest of your money can be loaned out. This is referred to as a fractional reserve banking system. The Federal Reserve sets the amount that banks can hold. This reserve ratio, again, is a percent of the demand deposits or checking accounts that they must hold on to, and they are not allowed to loan out. When the Federal Reserve decides they want to increase the money supply, it increases the amount of money that banks hold in deposits. Banks keep some of the money in reserve and loan out their excess reserves. These loans eventually become deposits for other banks, which will in turn loan out their excess reserves. If there is a recession, what could the Fed do to the reserve requirement? They could decrease the reserve requirements, requiring banks to actually hold less money and have more excess reserves. Banks create more money by loaning out the excess. So if the money supply increases, interest rates will fall, and this will incentivize businesses and consumers to borrow, thus increasing aggregate demand. But what if the opposite happens and there's an inflation? What could the Fed do? The Fed could increase the reserve ratio and the opposite effects could happen. This would essentially result in aggregate demand decreasing because interest rates have gone up. The discount rate is the interest rate that the Fed charges commercial banks. So an example, if Bank of America needs $10 million, they could actually borrow that money from the US Treasury, which is controlled by the Fed, but they would have to pay interest on that money. So to increase the money supply, the Fed would decrease the discount rate, and to decrease the money supply, the Fed would increase the discount rate. Open market operations is when the Fed buys or sells government securities. This is the most important and widely used monetary policy. So to increase the money supply, the Fed would want to buy government securities, and to decrease the money supply, the Fed would want to sell government securities. So how are you going to remember this? Think of B, buy, increasing, or big. Buying bonds increases the money supply. And the reverse, S, for small, selling bonds decreases the money supply. The federal funds rate is the interest rate that banks charge one another for one-day loans of reserves. The Federal Reserve cannot simply tell banks what interest rate to use, but they influence the rate through monetary policy, through buying and selling bonds. In this chart, you see a huge difference in the federal funds rate between 1979 and 2007. So the difference would be the inflation is the reason. In this graph, you see that the federal funds rate is really high in 1979 and then much lower in 2007. And the difference can be attributed to the radical differences in inflation. In 1979, inflation was very high relative to 2007. Monetary policy in aggregate demand and aggregate supply. If the Fed wants to increase the money supply to stimulate the economy, then interest rates would fall. And when interest rates fall, business investment spending would increase or consumer spending would increase. Aggregate demand would go up, GDP and the price level would increase. So here we see the money supply expanding, interest rates falling. Then we have aggregate demand going up here, real GDP going up along with the price level. And the reverse can happen. If the Fed decreases the money supply, then interest rates are going to rise. Business investment and also consumer borrowing is going to decrease. So aggregate demand decreases, GDP and the price level would fall. So that's shown on this graph, interest rates going up and aggregate demand falling. Why does the Fed want to slow down the economy? There's one word: to fight inflation. Monetary policy in bank balance sheets. So this chart shows a bank balance sheet and what's going to happen if the Fed buys $1,000 of bonds. The required reserves are still going to be 2,000 because the required reserves are based on demand deposits. Excess reserves are going to increase by $1,000. So because the Federal Reserve is buying bonds, excess reserves of the bank goes from 3,000 to 4,000. How much more can the bank initially lend out? They can lend out $1,000. The maximum change in the money supply would be 10,000. So the required reserve rate would be 2,000 divided by 20,000 or 10%. So the money multiplier is 10, 1 over the required reserve rate. And the maximum change in demand deposits across all banks would be 10,000. So what is the initial change in the money supply when the Fed buys $1,000 of bonds? Checkable deposits, demand deposits do not change. The money supply does not change until the money is loaned out. Bank reserves increase by $1,000 through that Fed transaction. Here's a practice question, and the answer is B. Another one, D. The answer is A. The answer is D. The answer is E. The answer is C. The answer is D. The answer is E. The answer is C. The answer would be C. The answer would be B. The answer would be E. And on these, the answer is B, and the answer is E. C, and the answer is E. And then here are some practice FRQs. So here's the question along with the answer key and the rest of the answer. And here's another one with the answer and another FRQ and the answer. And another one and the answer.